Hello everyone, this is Orhan Erdem, Associate Professor of Finance at Rockford University. Welcome to my podcast, Financially Yours, where I will share my perspectives on everyday economic and financial issues. We recently have seen the second and third largest bank failures in US history with total assets of $319 billion. In this episode, I will talk about bank failures and bank runs, more specifically Silicon Valley Bank, or SVB for short, and the financial meltdown happening around it. First, the story. Frank Capra's famous 1946 film, It's a Wonderful Life, is a classic that tells the story of George Bailey, who is a banker that takes over Building and Loan Association from his father when he died. The movie touches on several social issues, such as the importance of love and family on one side, and performing a socially responsible banking business and dramatizing a bank run on the other. And maybe that's why it's still inspiring after so many years. It's a Wonderful Life takes place primarily during the Great Depression era, which is between 1929 and 1939, during which a bank run occurs. The customers of Bailey Brothers Building and Loan panic when the word spreads that the bank is in trouble and rush to withdraw their money. George Bailey, played by Jimmy Stewart, was about to go on his honeymoon with his wife. When they heard about the bank run, George stops the car and runs to the bank to address the crisis. He sees the crowd in front of the bank and tries to calm them down by giving a short speech, saying, quote, "You are thinking of this place all wrong, as if I had the money back in a safe. The money is not here. Your money is in Joe's house right next to yours, and in Kennedy's house, and Mrs. McKellen's house, and 100 others. You are lending them the money to build, and then they are going to pay you back as best as they can. Now what are you going to do? Foreclose on them?" Unquote. Then he uses the cash he had saved for his honeymoon with his wife Mary and gives enough money to people to avert the bank run, and he successfully restores the confidence, prevents its failure. However, he faces another crisis later on because one of his employees loses $8,000. This time he can't find a solution and finds himself at the brink of despair. George decides to commit suicide by jumping off a bridge into a river on Christmas Eve. At that time, an angel comes and shows him a parallel life in which he was never born. Who could have suffered without him? Who could have died without his help, etc. The movie continues the discussion and communication between the angel and George, showing the importance of kindness, love, and generosity in a financial setting which might sound counterintuitive to some. I definitely recommend this movie to everyone who is interested in economics. Bank runs are the nightmare of the banking industry. Why? Let's review the basics of the banking first. Banks accept deposits and pay a small amount of interest to the depositors. Deposits are called liabilities because they have to be paid back. After receiving the deposit, they try to make money out of it. The most common method is creating loans. Banks lend money to people or companies who need funds for various reasons. The other method is investing some of these deposits in several financial instruments, such as government bonds. Banks might prefer to purchase government or corporate bonds. They would receive interest from these loans they lend or investments they make. They pay some of this money to the depositors, and the difference is their profit. The loans and the bonds are their assets. They make money out of assets, and they pay some of them to their liability holders. Banks keep a very small portion of the deposits as a reserve because depositors might come and withdraw their money, which is normal. However, when enough depositors rush to a bank at the same time for some reason, such as fear or panic, asking for their deposits, banks would first use their cash reserves, and when that reserve dries up, they would end up defaulting because the majority of the deposits are lent out to borrowers. This is called a bank run. To prevent a bank run, regulators develop several mechanisms, one of which is called deposit insurance. The Federal Deposit Insurance Corporation, FDIC, was established in 1933 for this purpose. They insure depositors up to $250,000 per depositor per account. Thus, if a bank fails, all deposits under $250,000 will be fully protected by the FDIC. Anything above this level is not protected. Thus, if a person deposits $1 billion to a single bank, for example, and that bank fails, only $250,000 will be covered. The rest, $999,750,000, is not under protection. Thus, millionaires must be very careful in selecting banks. Silicon Valley Bank was the 16th largest bank in the United States. It opened in 1983. Many of the technology companies, including but not restricted to Roku and Vimeo, were working with Silicon Valley Bank. Silicon Valley Bank received deposits mostly from Silicon Valley startups, which soared in the last couple of years. Its total deposits increased from $62 billion in 2019 to $173 billion at the end of 2022. In just 3 years, their deposits almost tripled. At the beginning of March 2023, the bank had $212 billion of assets, most of which are its depositors' short-term money. These assets are supposed to be wisely distributed among many financial instruments. This is commonly known as diversification, which is basically not putting all the eggs in one basket. Now, let me explain to you what an average American bank did with depositors' money and what SVB did with it. An average American bank kept 14% of its assets in cash to repay depositors, just in case, and the remaining 24% in securities and 42% in loans. SVB, however, did the reverse. The percentage of cash in its portfolio was 7%, while it was 14% on average in the market. And the percentage of securities in its portfolio was 51%, more than twice its peer average of 24%. So most of SVB's assets were invested in long-term government bonds. What is the meaning of this and why does it matter? US long-term government bonds or mortgage-backed securities are seemingly riskless investments unless you need to sell them for some reason before they mature. Their values change with changing interest rates in the market. If interest rates go up, their values go down. If interest rates go down, the value of government bonds go up. I will give an example to clarify this, but first let me explain how a bond works. A bond works by providing a stream of fixed interest payments to bondholders until it reaches its maturity date. Investors can trade these bonds in the secondary market, in which there might be price fluctuations. This is very similar to buying and selling a car. You might have paid $10,000 to purchase a car, however, its price might very well be $12,000 or $8,000 when you want to sell it. Here's the example. Assume that last year you purchased a long-term government bond for $100, which pays you $2 coupon every 6 months. So every 6 months you will receive $2 as a coupon. Assume again that this year now that the interest rates are higher. So your friend Mike bought a similar bond today for $100 again, but the coupons he would receive are higher, say $5 every 6 months. So he is going to receive $5 every 6 months, but I am going to receive $2 just because I bought it last year. The price is the same, but Mike's coupons are higher. So assume again that you need money this year and you decided to sell the bond you purchased last year. You can't sell it at the same price, right? Just because whoever buys your bond will receive $2. However, right now, for $100, people like your friend Mike can buy bonds from the market that pay them $5. Therefore, if you want to sell your bond, which still pays $2 to somebody, you could be charging less than $100, for example, $80. So the value of your bond decreased from $100 to $80, a loss of 20%. And this is mainly because the interest rates rise and your bond becomes less valuable. So if a bank is supposed to sell its long-term government bonds under an increasing interest rate environment, they might sell it at a loss. This is what happened with Silicon Valley Bank. Let me explain why. Federal Reserve Bank increased the interest rates 8 times since March 2022, and this increase posed a threat to most of the banks which held government bonds the most on their balance sheet. SVB was one of them. However, if you do not need to sell these assets, it's not a big deal. According to New York Times, supervisors at the Federal Reserve Bank of San Francisco, which oversaw Silicon Valley Bank, issued 6 citations but did not take any action. According to Reuters, a news agency, last year in 2022, SVB was evaluated by Federal Reserve as having satisfactory liquidity management. Please note another absolute happenstance here. Bernie Sanders mentioned this in his tweet a couple of days ago too. The Silicon Valley CEO, Greg Becker, was also a director at the San Francisco Fed, which was the body in charge of regulating Silicon Valley Bank. So as the interest rates started to increase in the market, most startups found it difficult to fund their ideas and operations. And because of the recent turmoil in the market, most of the tech companies have started to lay off their employees just because they were expecting a recession. Therefore, the startups turned to the banks to withdraw their money to continue their operations. So they turned to their bank to get some cash, which was SVB. However, SVB was holding only 7% of its assets in cash, so they didn't have enough cash, less than half of its peer average of 14%. So they decided to sell their long-term government bonds at a loss. When depositors, who are mostly firms and startups, asked for their money, Silicon Valley Bank had to sell its bond holdings at a $1.9 billion loss because they did not have enough cash. To recover this loss, they also decided to raise approximately $2 billion by issuing new shares, and this attempt boosted the bank, which resulted in plummeting share prices and a $42 billion deposit withdrawal in one day, a quarter of its total deposits. This is really interesting though. How come a 40-year-old bank lost $42 billion overnight? How can depositors be aware of the problem so fast? Well, the answer lies behind the fact that Silicon Valley Bank's depositors were very concentrated. They were a closely tied group of startups who were based in the same exact region. Most depositors knew each other. Bloomberg reported, for example, that Peter Thiel, who the listeners of this podcast would remember is the founder of PayPal, advised his customers and many portfolio companies to withdraw their funds from SVB. So the main reason for Silicon Valley Bank's collapse was a group of closely tied depositors' collective action, and in response, Silicon Valley Bank's fire sale of its government bonds to match this demand. Under normal conditions, the deposits, which are less than $250,000, were protected. However, 97% of the SVB's depositors, who are mostly billionaires, had money more than this amount. So these people panicked and rushed to the bank to withdraw their money. Let's pause here and talk a little bit about why SVB held so little amount of cash. After the financial crisis in 2010, America's Dodd-Frank Act was enacted to force the banks carry enough cash to withstand bank runs. However, SVB long lobbied for looser risk limits and lighter regulations by arguing that its failure would not create systemic risk and thus did not need to carry much cash. As a result of this lobbying, in 2018 and 19, during the Trump administration, Congress and bank regulators lightened the liquidity rules, particularly for mid-sized banks with between $100 billion and $250 billion of assets. As a result, banks with fewer than $200 billion in assets were excluded from many restrictions and oversight. Those changes left smaller banks with less stringent rules. Thus, they did not carry enough cash just because of deregulation that they themselves took the lead. After its depositors withdrew $42 billion and its investments substantially decreased in value, SVB was shut down by regulators on Friday, March the 10th, and was taken over by the FDIC. After the spread of SVB's news, other depositors in similar mid-sized lenders panicked too. One of these banks was Signature Bank. On March 12th, Sunday, regulators also shut down Signature Bank. Treasury Department, the Federal Reserve, and the FDIC got together and announced a plan called Bank Term Funding Program, whose aim was to help banks in trouble. Fed has lent $165 billion through its lending schemes. As a result, the depositors were made whole. In other words, all depositors, regardless of how much deposit they had, would receive all of its deposits back. This is what happened in 2008 and 9 too. The US government's bailout plans caused fury among the public. Former president of the New York Fed, Tim Geithner, said, "The government saved the economy but lost the public." Now it's happening again. The US government, with its financial institutions, have been intervening free markets. This behavior, which is simply some version of what they did in 2008 and 9, would encourage banks to take bigger risk in the future to attract more customers, because they would know or predict that they would not be accountable on their risks that they took. As Republican Senator Jim Bunning of Kentucky said in 2008, that this looks like a financial socialism. According to free markets ideology, bad performing banks should be left to fail, but it didn't happen. Ken Griffin, founder of hedge fund Citadel, told Financial Times that, quote, "The US is supposed to be a capitalist economy that's breaking down before our eyes," unquote. Days after the takeover, we learned many absurd practices of the bank. According to Bloomberg, for example, Chief Risk Officer left the company in October, but stopped performing the role in April 2022. The company said Kim Olson took over the job in December. Olson was based on New York, not San Francisco. Aftershocks continued for a couple of days. On Sunday, March 19, Swiss authorities arranged a takeover of Credit Suisse, a 167-year-old Swiss bank, by its rival UBS. And the Federal Reserve increased the interest rates once more after the collapse of Silicon Valley Bank. We might see more mid-sized banks, which were deregulated in 2018, struggling because the values of the bonds in their assets are decreasing in value. Currently, it seems that the markets calmed down. However, this is mainly because of the US government's massive intervention. No single problem is addressed yet. It's worth to remember here a very interesting coincidence. Last year's Nobel Prize in Economics was awarded jointly to Ben Bernanke from the Brookings Institute and the former chairman of Federal Reserve, Douglas Diamond from the University of Chicago, and Philip Dybvig from Washington University, for research on banks and financial crises. We reviewed too much, right? So let's summarize everything. It seems that the crises become part of our daily lives. We have seen one medical crisis, COVID-19, in 2020. Then came the Russia's invasion of Ukraine. Both of these crises contributed to spurring inflation worldwide. Now, the world has been struggling to decrease inflation, and one of the most common tools to cope with inflation is the interest rate tool. Federal Reserve Bank, as well as many other national banks, have been increasing the interest rates. Now, the problem is the interest rates have been pushing some less regulated banks to the brink of collapse. Nobody knows what's next, but it's apparent that the high interest rates will be the main determinant of the coming couple of years. As always, you can reach me via Twitter or email. My Twitter handle is Orhan Erdem, which is D as in Delta, R as in Romeo, my first name and my last name together. My email is orhanerdem@gmail.com, which is my first name and my last name together. See you in the next episodes. Financially yours.